Please welcome to the stage, Bloomberg's Lulu Chen.
Good evening, everyone. Welcome to our special dinner session at Bloomberg Wealth Asia. It's so lovely to see so many familiar faces in the audience. We had some of the best minds and leading asset managers, wealth managers, economists, and investors speaking at our panels earlier today. We're really excited to invite all of you to our special dinner tonight, and a special shout out and thank you to our sponsor, Royal Bank of Canada. We can't wait to hear more from our panelists. Later tonight, we have a lineup of excellent speakers, and a special shout out to all the audiences viewing from online. While we want to hear more from our panelists, we're also keen to hear what the audiences in this room are thinking, so we will be polling. You can send in any questions you have during the session, and let me show you how it works. So you can scan the QR code on our screen, and this will allow you to send your response for our questions. So can you please pull up one of the sample polling questions? So for our sample question, we have, are we saying goodbye to the 60-40 portfolio? And your answers, yes, we need new models, versus no, 60-40 is still a good strategy. Can you pull up the QR code again so the people in the audience who were speaking earlier can bring up their cell phones and scan the QR code? Okay. And as we wait for the results, just a reminder, we have an excellent, amazing speakers lined up, including Terence Chow, CEO, Wealth Management Asia, Royal Bank of Canada. We have senior analysts from Bloomberg Intelligence later tonight, and Jessica Jones, head of Asia at PGIM Investments, who will be our panelists. Okay, so let's see what you thought of the questions and your results. I guess we have a winner. Yes, we need new models. The majority of the people in this room believe that we do need new models. And one final thing. You can also engage with us on social media. We are trending on social media. The hashtag is BBG Wealth Asia. And thank you for joining us again. Have a great evening, everyone.
Please welcome to the stage, Terence Chow, CEO, Wealth Management Asia, Royal Bank of Canada.
Hello. Good evening, everybody. It's always so great to see everybody looking dashing and dressed up in a lovely venue. My name is Terence Chow. I head up the wealth management business at the Royal Bank of Canada. Before I go on and on, I do want to extend a special thank you to all of the staff here at Rosewood for hosting such a wonderful event and taking such good care of us. Obviously, thanking our colleagues and our partners at Bloomberg for putting this on and really curating an excellent panel of experts and specialists to talk about a very, very poignant topic, which is wealth in Asia. And of course, to my fellow co-sponsors as well, HSBC and Invest Hong Kong, thank you for joining us in this event. It's good to be back in person. It's the first one in 4 years in Hong Kong, I was just recently told, so I'm glad we're part of it, so that's amazing. Hopefully some of you, or maybe even most of you, were able to join the entire summit during the day. There were a lot of different topics that were discussed, everything ranging from your usual things, right? ESG to next generation to women and wealth, geopolitics and global macroeconomic types of headwinds that we're all facing and all of your clients are probably facing. As well as disruptive technologies like AI and ChatGPT, which is kind of the flavor of the day, and what that might imply in terms of society more broadly. But I guess the recurring thought for me anyway throughout the entire day was, okay, so what? Or what does it all mean? And I keep going back to, well, the word wealth. Like, what does wealth actually mean? How do we actually connect all these dots to make sense of what wealth is supposed to be? And for me, it's probably more of a personal analogy because I recently became a father just a little over a year ago today. And so with a 1-year-old daughter, I start thinking about, okay, what does that mean for her? And so I guess when I think about wealth, and it's going to be different for everybody else, it's really about family and loved ones and friends and how all of us can be prepared and the wealth can be managed in such a way such that your loved ones and your family and your friends are taken care of. And that could mean immediate family members. It could mean other philanthropic pursuits that one might need. It could mean the community in which you kind of live in and operate in. And so at RBC, right, we always ask ourselves why, because the what and the how, that's obvious. But why are we doing it? And it's really about our clients and helping them thrive. And of course, the communities in which we operate in and helping them prosper. So I think when I think about that notion of, okay, what exactly is wealth and what exactly are we trying to accomplish? I go back to that, right? I try to distill down all the technical jargon and all of the buzzwords and everything else that might be kind of front and center in all of our minds, and think about and reflect on what does it actually mean for me personally and what does it actually mean for our clients personally. And if we can answer that and if we can address that, then I feel like we probably have it right. I know that I'm between you and a lovely dinner planned, as well as some really, really smart speakers, so I will end it there. I want to thank you all again for coming out. Thank you for engaging in the dialogue and the conversation. Hope you have a wonderful evening, and we will look to speak again soon. Cheers.
Please welcome to the stage Sarah Jane Mahmood, Senior Financial Analyst, Bloomberg Intelligence, and Sharni Wong, Senior Research Analyst, Bloomberg Intelligence.
Hi, it's great to be here. My name is Sharni Wong. I am a Senior Research Analyst with Bloomberg Intelligence. With BI, we are the independent research arm of Bloomberg. We cover over 2,000 companies. Oh, okay, sorry. Hello. Is this working? Okay, great. Yeah, we cover over 2,000 companies, and also our team of experienced research analysts have over 20 years of experience. So to find our research, you can type in BI Go on the terminal. So I will kick off. Singapore versus Hong Kong as Asia's wealth hub. Now, with today's great lineup of speakers, I think the message is quite clear. Asia is definitely the place to be right now when it comes to private wealth management. Wealth creation in this region is expected to outpace the rest of the world, and that's led by strong economic growth as well as China's rising middle class, which will then fuel the number of high net worth individuals in this region. So Hong Kong and Singapore as Asia's wealth hubs, they're both clearly very well placed to benefit. Now, when we look at household wealth over the past couple of years, Singapore has done better. So here you can see that since 2019, Hong Kong has lagged behind, for obvious reasons with the political situation and then followed by COVID. But at the same time, Hong Kong is still double the size of Singapore. So even if we assume quite optimistically that Singapore can continue to grow much faster than Hong Kong at close to double digits, it's still at least going to take 17 years before Singapore can catch up to Hong Kong. And actually, most recently, with the reopening, we actually don't think that this is very likely. One big example would be, during COVID, the number of mainland migrants that fell a lot. So in 2021, when we look at the one-way permit schemes, the level in 2021, it was about 40% of pre-COVID levels. So starting from this year, we really do expect that rebound in migration from mainland China to continue to fuel Hong Kong household wealth here. Sorry. Oh, okay. Right. And moving on to cross-border wealth. Now, both Hong Kong and Singapore are both doing very well, ranking as the second and third largest. And actually this year, Hong Kong is expected to overtake Switzerland as the world's largest cross-border wealth hub. Now, also we've got the banking turmoil in the US and also in Switzerland. So we do think that that's going to give an added boost for both Hong Kong and Singapore. Singapore also had a head start in emerging from COVID. So we saw a lot of family offices that set up in Singapore. But Hong Kong, I think, the government, they are really trying to attract family offices back to set up here now that we have reopened. And they are introducing tax concessions to attract these family offices back here. And one clear edge that Hong Kong has that Singapore doesn't would be the financial infrastructure with China to facilitate cross-border flows. So on this, it's going to be quite beneficial for Hong Kong to have that edge with the mainland cross-border wealth. Now, this, I think this chart, it paints a pretty clear picture in terms of the rebound after reopening. So, as I mentioned, with the various Connect programs, this shows the southbound wealth management Connect sales. And in just 1 month, month on month, it grew 70%. Now, this is very solid, but going forward, we do expect this positive momentum to continue. And there are quite a lot of reasons supporting that. So number one would be the COVID era savings on the mainland, where mainland Chinese households, they saved 1/3 of their income in 2022. And a lot of these funds that were parked in deposits, they will likely flow into financial products as well as looking to diversify overseas, which through the Southbound Wealth Management Connect channel, it offers an easy way for them to do so. And then right now, the rules are still quite restrictive, but going forward, as the HKMA said this morning, they are looking at expanding the rules to allow more medium to high risk products to be included in the Wealth Management Connect. The other key driver would definitely be the Fed, with the interest rate differential growing, and with Hong Kong and also US dollar financial products with more attractive yields, while China could still be easing their monetary policy. So I'd just like to touch quickly on Credit Suisse and UBS. Now, we all know what happened in March, and actually today there was some news on the restructure. But even prior to this year, in 2022, they actually saw net outflows of net new money, and that's both Credit Suisse and to a much lesser extent UBS. But this is in quite stark contrast to very strong wealth inflows, as you can see on HSBC, Stan Chart, DBS, the Sing banks, and even onshore in China. Now, the first quarter numbers are not well disclosed, but based on the ones that are available, it's quite clear that the trend in the first quarter has continued. So going forward, we do expect these Hong Kong and Singapore banks especially to benefit. So on that note, I'm going to hand over the floor to Sarah. So she's based in Singapore, and we'll talk more about the international flows as well as Singapore. Thanks.
Hello, everyone. I'm very delighted to be here. I flew in from Singapore on Sunday and very much enjoying the less humid weather. So, Singapore. Singapore has established itself as one of the world's leading wealth management centres over recent years, and I think it's very well positioned to grow and win net new money with the ongoing integration in Switzerland. with the deal expected to complete over the next few weeks or so. And with weaker trust now in the Swiss banking system and heightened regulatory scrutiny around the merger, it's possible that wealthy clients could look at establishing wealth management relationships with other institutions, especially those who do have sizable portfolios at both Credit Suisse and UBS, to diversify their holdings. And in my opinion, I think banks based in Singapore are perfectly positioned to gain market share here. Now, Singapore on the whole has gained assets under management, growing at a 15% compound annual growth rate since 2016, rising to $5.5 trillion in 2021, according to the latest regulatory disclosures. Now, over 75% of these assets originated from outside Singapore, as you can see from very diverse sources: North America, Asia, outside of Singapore, and Europe. And also the city-state has seen an influx of high net worth and ultra high net worth individuals and their family offices, rising from only 400 in 2020 to over 1,500 last year. And with the introduction of a new philanthropy tax incentive that was announced on the Valentine's Day budget this year, I think the growth in family offices is likely to continue over coming years. Now, Singapore has the right ingredient to attract more high net worth investors, aside from its geographical position as a gateway to Asia. And I think its appeal is supported by a very business-friendly regulatory environment which supports digital asset investing, among other things. Low taxes, stability, low corruption risk, and also a golden visa scheme, which is quite important at this time when many of Europe's doors are starting to close, particularly in Portugal, Ireland, for example. For now as well, Singapore has a much more business-friendly anti-money laundering and sanction screening regime than you might find in the US and over in Europe, which could help speed up the client onboarding process. Singapore is also at the heart of the world's nature and biodiversity crisis. In Southeast Asia, around 63% of GDP is at risk from nature loss. So Singapore does present significant ESG opportunities, and investors can play a significant role in the shift to a nature-positive economy. Singapore is also on track to be Asia's Centre for Philanthropy, in line with the Financial Services Industry Transformation Roadmap 2025, and the regulator's strong desire to collaborate, to work with family offices to help them identify and meet their charitable objectives and to quantify the impact that they are making on society. And I think in all, these factors do give Singapore an edge over other financial centres, potentially Hong Kong, Switzerland with the current crisis, and London after Brexit. Now, the integration going on in Switzerland is likely to spice up the battle for talent in wealth management in Singapore, and it will in many ways fill the existing talent gap that has been stretched by the growth in family offices and also the expansion of foreign asset managers in the city-state. But the banks in Singapore, they generally tend to have a lower cost-to-income ratio than their peers, around 38 to 43%, versus the peer average of 66%, which does put them in a relatively good position to beef up their relationship management teams over coming years. And finally, despite the recent downturn because of the pandemic, Singapore banks are finally seeing an uptick in wealth management fee income. In the first quarter, DBS saw a 39% rise and UOB a 27% rise. And I'm expecting a similar story to be released by OCBC tomorrow morning when they report their first quarter results. But on the downside, potentially, the Singapore banks, despite their regional expansion plans, they could be seen to lack the global clout. I mean, global connectivity is ever more important these days, with more and more families relocating across the globe and wanting to go to a one-stop shop that can serve the generation anywhere at any time. On a final note, Europe's asset managers are also trying to scale up in Asia, not just in Hong Kong and Singapore, but in mainland China, in India and Korea too. And this is a trend that I saw intensify during the 7 years that I covered the sector for BI in London before I relocated to Singapore last year. And I found that most of these European asset managers, they're looking to expand in the Asia region by entering into joint ventures or partnership agreements with local banks to tap the market. And yes, growth has been slowed down by the pandemic and market dislocation, but I am starting to see momentum build up again. And I think it's going to be very interesting to see what the next few years hold. So all of our research on this topic and so much more is available on the Bloomberg Intelligence portal at BIGo. Thank you very much for your time and have a very pleasant evening ahead.
Please welcome to the stage Jessica Jones, Head of Asia, PGIM Investments; Angelina Lai, Chief Investment Officer, Asia, St. James's Place; and Geng Xiao, Director of the Institute of Policy and Practice at the Shenzhen Finance Institute, Chinese University of Hong Kong, for a conversation with Bloomberg's Shuli Ren.
Good evening. Hi. Hello, everyone. We know we are getting in the way of your dinner, so we'll just get started immediately. Jessica, I will start with you first. Given all the macro uncertainties, what are the potential impact do you see in Asia? What are the trends that you are seeing in the wealth management industry?
Great. Well, thank you, Shuli, and thank you, Bloomberg, for inviting us, and RBC as well for sponsoring. It's fantastic to be here. In terms of the trends and what we're seeing for clients in Asia and the Asia wealth management industry here, as was mentioned by the Bloomberg Intelligence team, one of the big things we keep seeing, despite all these gloomy headlines we're seeing, in terms of global volatility and a slowdown in global growth, we still see Asia continue to shine and continue to grow from strength to strength in the wealth management industry. We also see, in terms of great trends that we're seeing in the region from our private banking clients, we see this continued rise in demand for alternatives, for private markets. And that's especially true in the semi-liquid space from private banking clients. And thirdly, we're seeing this continued demand for investor education, be it more data, more stories, because this is such a new asset class, this alternative space. We're getting asked a lot of the time by clients to just share more information, more data to help these clients become more familiar with this asset class. So just to drill down into that a little bit, to draw on some of the points mentioned by the Bloomberg Intelligence team, we continue to see Asia being boosted, I guess, by the China reopening trade, net flows into the region that you see on a cross-border basis, but also on a local fund basis, continues to be positive for the first few months of this year. And, with all the growth trajectory that we see in Asia, reports keep suggesting that the whole Asia region will probably be home to nearly 25% of the wealth management industry as early as 2026. So it's a very exciting place to be. In terms of the rise of demand that we see in alternatives, well, clients are telling us that they're most interested in are products and strategies that are focused on real estate, private credit, and also global macro solutions. And this is because these are solutions that help diversify client portfolios. It gives them access to things that are a little bit uncorrelated into their portfolios. But clients in this region are still so under-allocated to alternatives. When we speak to the big product gatekeepers that focus on alternatives with all the big private banks out here, the numbers are still around like low single digits allocation to alternatives. But the house view is to try and increase that, depending on the risk category of a client, but really increase that to something like 15 to even 30%. So a lot of room to grow in the space.
Interesting. So the alternatives that you're talking about, and please feel free to jump in, Angelina and Professor Xiao. Are you like, I've been hearing that some clients are having second thoughts about private equity. The alternatives, is that the trend that you're seeing? Like, are they getting more interested in private credit, for instance?
Oh yeah, definitely. I mean, I think it's a very diversified allocation to alternatives, and clients, are looking for interesting ways to access that. And as I mentioned before, solutions that can provide redeemable features or, liquid options, quarterly liquidity, monthly liquidity. So, a lot of the alternative managers out there are becoming more creative in terms of finding ways to capture the imagination of the private wealth market in Asia and find solutions that maybe not be as longer dated, putting your money away for 10 years, but something that can offer better liquidity.
Interesting. I would like to take a more cautious tone. So it seems like cash is no longer trash. And global institutional investors, they've been sitting on outsized cash for 7 months consecutively, the longest time span since the 2000 dot-com bubble bust. Angelina, do you see that kind of caution taking hold among private wealth clients in Asia as well?
And thank you, and thank you for having me here as well. I'm delighted to be here. So certainly from St. James's Place, which is has a large client base in the UK, with the number one in the UK, and then sort of we're growing quite rapidly in Asia. Amongst the mass affluent as well as the high net worth space, which is primarily our client base, we're actually not really seeing that. We see a lot of client queries about, should I be taking out my investment? Should I be parking it in the money market fund? Should I be sort of taking more cautious views? Where do I hide amongst the last year, 2022 was one of the worst years in terms of correlation between fixed income and equity. So the traditional 60-40 probably had its worst ever performance sort of in a 100-year history of where you sort of had a data backdating to check on this. But actually Jessica makes a really interesting point about alternatives. And this is sort of where we come in with, portfolio management and asset allocation in the value add of those allocation strategies. And alternatives sort of range from both a illiquid in the private space, which we believe tend to need to be more advised, and also sort of given the entries and exits and the characteristics of the assets and complexity of the assets, needs a bit more advice and quite often also a bit higher investable asset base, versus to the more liquid range, particularly sort of around infrastructure, property, and commodity, which obviously did extremely well in times such as last year. So what we tend to actually see is, yes, we do get clients querying around, actually, should I be taking investment out? But because St. James's Place is all about advice, and we believe very fundamentally, and agreeing with Terence early on around the advice to wealth management, we actually hold our clients' hands along the way and say, actually, in times like this, it's best not to be taking losses, realizing your losses, but actually staying the course.
So a lot of Asian wealthy clients, they actually unfortunately bought into Credit Suisse AT1 bonds. I have talked to quite a few myself, and some of them are quite disgruntled. They complained about their private bankers. Do you get queries like that? And what is your advice to clients?
Actually, it was quite interesting because I was actually quoting FT just shortly after the demise of Credit Suisse and the whole AT1 bond debacle. We actually had a query from our sort of high net worth clients as recent as 3 weeks before Credit Suisse went down, on essentially exactly sort of their private bankers talking to them about, actually, here's a really interesting yield. This is code. I won't mention the bank name, and there's coupon names and some years against the yield. So everything sounds really attractive, but again, sort of to what I was mentioning, there is usually a minimum entry size or minimum
size, and to most clients, that's quite a large proportion of their assets. And what we quite often advise our clients is, unless it's something that you understand and know really well, it's always best to just diversify and let the expert do their job. So within our own funds, our fund managers will have an allocation, but obviously we have the benefit of wholesale, so we are able to aggregate all of the assets and enable the clients into a proportion of these asset classes, because of course there is certain risk premium. So every asset we invest in, we're looking for that risk premium, that alpha. But then every risk premium comes with the risk, and therefore we have to diversify away that risk. So advice to our clients at the time is very much that we do not recommend for you to be investing at that level proportion of your wealth. However, much higher net worth clients or family office, etc., that could become a managed portfolio of sort of assets if the investment team within the family office, or sort of, if you're actually investing with us within the funds that we're investing in, then that makes sense.
Yeah, that makes sense. I believe the Credit Suisse bond, the minimum lot is 200 grand, so exactly. It is a lot. Professor Xiao, I will come to you next on geopolitics. China's wealthy clients, they're stuck in a really tough place, right? Like on the one hand, we have common prosperity on the mainland. On the other hand, is their money really safe with foreign Western banks in the event of a possible political conflict between China and the US as soon as 2025, according to some military analysts? Based on your conversation with clients in China, how do they perceive wealth now? Where do they want to park their money? What do they want to do with their money? Do they still have this animal spirit? I have a lot of questions.
Yeah. I think the fact is that there's so much uncertainties around the world. For Chinese, used to invest everywhere in the world, but now the safest place actually for offshore assets is right here in Hong Kong. But I think most of the actions by high net worth people to put money outside is actually quite normal. It happened regularly over the last 40 years. Because if you look at China's balance of payment, there's a lot of foreign exchange disappeared. Basically, those are the money which resides overseas. And we can observe that by looking at the foreign direct investment every year, flowing into China. More than 60, at the peak 75% are actually through Hong Kong. So Hong Kong is really a very important platform for Chinese, basically people to diversify and use it as a buffer. And particularly when the opportunities for real investment happen in China, that happened very frequently over the last 40 years, they will come back. So what happened in the last few years is that Hong Kong is actually at the lowest point in its history, I think, and that's why we see a lot of money moving to Singapore but actually this is quite normal if you look at the last few decades. Those money will usually come back when the opportunity in China re-emerges. And I think right now is actually the turning point. Both China and Hong Kong, from macro perspective, was at the lowest point in the last 3 years. And it's very clear policy-wise, the macro conditions are changing. But I think for most families, and the companies, they still needs to observe to see the real opportunities. Actually, they can really make money in China and in Hong Kong, and that is something I think in terms of the timing, this is the probably best time for investment, but the uncertainties are still there. And if there's no uncertainty, then the housing price, the stock price will go much higher. So this is the cheapest time, I think, for investment in Hong Kong and also in the Greater Bay Area and in general in China. And I think you mentioned geopolitics about the so-called war, the Taiwan. Those are extremely low probability events. And my view is that the real issue is about how China and the United States can basically peacefully coexist. And Taiwan is not the issue. And China have no incentive to take back Taiwan without having reasonable relationship with the United States. So I think those exercises, those military exercises, which will continue, but the bottom line is that around the world, Asia, and particularly China, is still the most vibrant economic areas. So I think this is the time to really think about the risk and return. There are low risk, but the real returns are very high. I did some investment last year in the property market because it's just so terribly pessimistic. But I think today, we are seeing the turning points.
I want to follow up on your point about foreign direct investment. I often wonder, where are the real sources of all these FDI? All the money coming to Greater Bay, are they really out? Some of it, you see that it's a Singaporean-based company, but are they really Singapore money or mainland money that is parked in Singapore that's being rewired into China? What's your observation on that?
Well, this is my research 20 years ago. There's this what we call round-trip FDI. Basically, most FDI money is actually created in the developing country, like China, like Guangdong, right? But usually, developing country, they have problems in rule and law, all kind of trouble. So money, the wealth once created, will usually flow into places like Hong Kong, Singapore, and the US and Europe, right? And then when they, when the entrepreneurs, when the companies actually expand, they will move those money from overseas into China, Guangdong. So those FDIs are mostly, it's not really foreign money, it's actually indigenous money, but disguised as, FDI. So this is not secret. We know, but statistically, it's still foreign direct investment. How can Hong Kong have 75% of China's FDI, at the peak? And usually it's more than 60%. If it's foreign money, they can move directly into China without going through Hong Kong, right? So Hong Kong plays an extremely important role to park China's offshore money, the Chinese money.
So offshore Chinese money that's guised as not Chinese money.
Right.
It's very interesting. I just think geopolitics is an interesting topic because, with the wealth management companies and stuff, we are all talking about portfolio diversification. That's basically Asia money investing in Europe and the US, right? We like to be global businesses, whereas, politicians, they want us to decouple. How does the wealth management industry deal with this politics right now? Angelina and Jessica, you want to take on this topic?
Sure, I can start that. I think when we talk about geopolitics, geopolitics is always in a total different state of play, and I'm not really going to comment on the current situation of the geopolitics. But what I can comment on is what our clients are telling us about this global theme and where they want to invest. And I know you mentioned, politicians keep talking about decoupling, but when we talk to our clients, they're really focused on how do we create global portfolios for our clients that are really diversified across all these different regions, all these different jurisdictions, and then across asset classes. For example, a lot of conversations that we're having with clients right now is on Asia and Asia private market solutions, Asia real estate in particular. For those of you in the room who might not be familiar, PGIM has been managing real estate since 1994. So we have a 28-year history managing Asia real estate assets. We're probably one of the longest running Asia real estate managers. And clients are coming to us on the private banking side and saying, we have a lot of solutions for our clients with US real estate and with European real estate, but we see Asia as an important part of that diversification. And it's also, there's a lot of, there's low volatility and there's a lot of income, and we can be invested in parts of Asia, some of the mature markets, like Australia, Japan, Korea, Singapore, and Hong Kong, but also in different sectors of real estate in Asia, such as logistics or multifamily living. So clients are really, not really focused on the headlines so much, but really thinking about how do I complete my portfolio and have options and solutions that complete that whole cupboard and create a global portfolio.
I agree, and I'll supplement a little bit, and I'll come at it from two different angles. One from a investment angle, so global investment that Jessica was referring to, as well as also then the client side and where we see, I guess, the inflows coming from. From the investment side, I absolutely agree with what Jessica is observing. Our clients are looking global, and that's why they quite often look to us where we invest globally, but obviously have a very strong UK base and European base, and they look for advice in terms of the holistic advice around the sort of assets they would invest in. And I mentioned holistic because actually we probably look at it slightly differently from a wealth management perspective. We more talk to our clients about what are their longer term financial goals. Is it for intergeneration transfer? Is it wealth? Is it retirement? What are the goals? And then we talk about how do we construct a portfolio that supports those kind of goals. And then it's really about how do we maximize that portfolio subject to the client's risk appetite, right? Mm-hmm. And then within that, we then work out a core portfolio with our clients, and then potentially some of the more interesting investments that they sort of might be interesting or might sort of help them to achieve some of these goals. Some of these might be real estate, some of these might be private assets, but certainly we are looking at a global basis. And certainly from a valuation perspective at the moment, US has been significantly overvalued for the last decade. It has massively outperformed, and it's making any tilt that we sort of, or any conviction that we have taken on the more sort of lower valuations over the last few years, quite difficult to compete with. But at the same time, Asia is currently looking so extremely attractive. I will take an example actually that sort of just coming onto that point around the regional diversification and then sort of the decoupling of the investment and geographical allocations. In 2010, when we sort of look back in history, that has been, a year and a half post the global financial crisis. Every economy feels like they're suffering. It feels like there is no light at all. But actually, emerging market completely outperformed. China had brought in significant outperformance, and everyone sort of, limelight on China, on Asia, on the emerging market. And most of the sort of people and investment and focus tend to be around that emerging market. However, since 2010 to end of 2022, if you had invested your entire asset in emerging market, you'd have gained just 88% or around 6% compound annualized returns. Whereas if you had invested in a global investment, so the MSCI Equity, for example, which by the way is about 60% US by the end of last year, mostly due to the tech dominance of the US economy, you'd have gained a massive 166% or annualized double digits returns. But looking back at this point in time, as I sort of coming back to it, looking back doesn't always help. And if we sort of talk to our clients and so on, we're probably more actually saying, yes, there is probably some sort of deglobalization, decoupling going on. There is quite a few interesting challenges the US economy is facing, all of the regional banks that we talked about consolidating. There's the debt ceiling discussions. There's an inverted yield curve also. The 2-year to the 10-year differentials on the treasury rates is currently at the lowest in 40 years. And for the last 30 to 40 years, every time actually the differentials come to become negative, it's always followed by a technical recession. So actually looking to China at the moment and something sort of closer to heart, the manufacturing output, etc., has been the strongest for quite some years. So whereas the valuations are sort of looking very, very attractive. So it's quite an interesting play if we're sort of looking at geographical differences between from an investment angle. But actually coming back to the client that I was talking about earlier, and it was really interesting, Professor Xiao was talking about the round trip FDI and so on. We certainly see quite a bit of that attraction. And being Hong Kong, for example, with the asset management, the Wealth Connect of the Pearl River Delta area, and in general, sort of we get quite a lot of inquiries from potentially sort of mainland or sort of family office, etc., that may be set up in Switzerland or maybe set up in other jurisdictions. But then we we see a lot of sort of China proximity money. But then quite interestingly in Singapore, and I think the ladies at Bloomberg Intelligence talked about earlier, there's actually quite a strong inflow in the last couple of years, perhaps due to COVID, perhaps due to the border closing, perhaps due to other concerns, that we're actually seeing a huge amount of inquiry in our Singapore office around actually putting in private asset money.
Yeah. So one question that I think a lot of us are interested in is about Hong Kong. I mean, it's no understatement that Hong Kong suffered during the pandemic. And I congratulate those of us who decided to stay instead of moving on to Singapore. Going forward, what should Hong Kong do to ensure that we can actually recover and reclaim the crown of asset management? I mean, there are a lot of competition out there, right? Singapore, Dubai is a rising booking center. Professor Xiao, I will start with you here.
Thank you. I think for Hong Kong, this is really now is a very unique window of opportunity in the sense that if you look at it from China's perspective, Hong Kong is becoming more and more important. I think it will be more important than the last 25 years and even last 40 years. Because Hong Kong is a great platform for China's external circulation. China have a dual circulation, right? Domestic circulation, external circulation, right? So basically offshore economy. And this is actually happening in the sense that the integration between Hong Kong and the Greater Bay Area has a unique feature in the sense that President Xi Jinping came to Hong Kong last July, and he clearly basically pointed out, Hong Kong is going to continue to have capitalistic lifestyle. Common law will be practiced here. And Hong Kong should continue to be fully integrated with the global economy. Right. So clearly, there's no intention from China to change Hong Kong, right? And particularly Hong Kong, one strength of Hong Kong is that there are 10% population which are not holding either Hong Kong passport or China passport. So here, people around the world come here if you're at home, right? And this has been clearly recognized by Beijing. So this is an opportunity. And another opportunity is that, in the future, I would imagine, a lot of Chinese, they will come to Hong Kong as so-called talents, but they may not actually live in Hong Kong, but they're going to bring money. They're going to bring a lot of great companies, to be created in Hong Kong, but actually operating, around the global Bay areas. In the last 40 years, Hong Kong has, Redshift, share, Stock Connect, the Bond Connect. All this innovation is basically helping China to solve its own problems. And in the future, the biggest problem is really how to help China to put its exploding onshore asset, somehow diversified, into offshore asset, because this offshore asset it's like the glue to connect China and the global economy, which I think is the major challenge for China, and it is clearly recognized. And I think Hong Kong will be used as a platform to connect China, mainland, and also the rest of the world. And this is particularly urgent and challenging because of U.S.-China relations. I mean, it's an opportunity. I think both the current chief executive recognize and the Beijing also recognize. But it's going to take some time for the message to really to penetrate, to actually also create the policies which are fit for this new purpose.
Jessica.
Yeah, I mean, Hong Kong has definitely bounced back, and it's wonderful to be here and seeing, the buildup of people coming back to Hong Kong and all these conferences, like this Bloomberg one, being back in Hong Kong after 4 years, and all the events and big scale events like Art Basel and Hong Kong Sevens and things being back. And in terms of a growth, a global wealth management center, Hong Kong, of course, is always going to be a very, very important center. And as was mentioned before, Hong Kong right now, according to the Boston Consulting Group, is the second biggest offshore wealth center after Switzerland. And with, hopefully in a year or two, it will probably leapfrog Switzerland and be the #1 booking center, closely followed by Singapore. So, I don't think there is much, much point in really having this debate around Hong Kong versus Singapore, because both of these centers are very, very important for Asia as an offshore booking center, and both can grow, without at the expense of the other. They can grow together. And to the point on clients in Hong Kong and clients in Singapore, want to have big family offices, want to have multiple places to diversify the jurisdictions where their money is. So both centers can coexist and enjoy growth together. In terms of what more Hong Kong can be doing to continue building out for the next 10, 15 years, of course it has such an amazing proximity to China, and it's the gateway for mainland China, but also to the rest of the world as a super connector. And there's so many extraordinary benefits of Hong Kong as a market, being the global renminbi offshore hub of the world, having a very favorable tax system, having a very large and robust capital markets, private equity, co-investment opportunities. All of this is attractive about Hong Kong. And a lot has been done recently by the Hong Kong government to create policies and incentives to try and attract more growth and more family offices to continue to grow, and also attract family offices and high net worth individuals from other jurisdictions in Europe, Middle East, to consider Hong Kong as another home. But in terms of other things, we talked about the Wealth Management Connect program earlier on, and was discussed earlier today by the HKMA. Eddie was saying, how there are a lot of discussions around like this Wealth Management Connect 2.0. There's a lot of policies, being thought about. How do we add more products to this Connect platform? How do we, relax some of the quotas, so that, especially for individuals. So, I think some of those new enhancements are going to continue to propel Hong Kong and the flows that we see in Hong Kong, and other measures that are talked about by our clients and also industry players like the Private Wealth Management Association of Hong Kong created a report and mentioned points around how more can be done in terms of branding on the international stage, what's happening in Hong Kong, because a lot of other centers don't really know, all the ways forward that Hong Kong has come since then. And then, of course, the other way of improving Hong Kong's recovery, I think, is to continue to find ways to attract talent, and as well as high net worth clients back to Hong Kong who may have left. And whether that's like, making more training programs, making this a great career destination, creating, making it easier for people from overseas to get work permits here. All of these are steps to continue the great steps that we've seen in terms of Hong Kong's recovery.
That was a very passionate speech on how to make sure Hong Kong can recover. And that concludes our panel discussion. Thank you so much all for coming, and enjoy your capitalist lifestyle. Thank you so much. That was fun.